Okay, so as I mentioned the day before yesterday, once we have completed the income statement, cash flow statement, and as much as we can um, in that cash flow statement, meaning leaving out depreciation and working capital and those items, we are now ready. What we really want to do is do the depreciation schedule, working capital schedule. We want to look to those schedules to fill out the cash flow statement, but we can't because we can't complete them because those schedules are dependent on the balance sheet. So we need to create the balance sheet adjustments. And so just to give you an overview as to where we're going now. So today we'll do the balance sheet adjustments. Then step after that is building out depreciation, working capital, balance sheet, debt schedule. We'll go through those relatively quickly through Monday, Tuesday, and then by Wednesday latest, we'll start getting into the leverage buyouts portion. And that'll be a little bit different because it lends itself to case studies and other types of kind of interview prep stuff, and then obviously a different perspective on the analysis, so something new. So I guess the first task in a balance sheet adjustments tab, before going through the process of making the adjustments, we need to lay out the acquirer and target's balance sheets. Now, in a template, it was easy. You pulled in acquirer cash, you pulled in target cash, and just copied down because the line items were the same and identical. It was a template. You won't have that luxury in a actual case. You'll have acquire line items that'll be different than target line items. Now, in this case, so Daniel, to your question about the line items, in the cash flow statement where I said, well, cash from operations, these other line items, just list them out as is, because there's maybe 5 or 10, and that's an opinion. You can group them into other. I could have grouped a couple things. In the balance sheet, I want to be more careful because it could get lost if you have like 100 different line items, which you would because the balance sheet is big, right? In the cash flow statement, it's just the other line items, which are maybe 5 or 6 in each, that could be one-off and unique. Here, you don't want 2 receivables accounts. You don't want 2, acquire and target inventories accounts. You do want to do some combination. So you definitely want to try to take as much educated guesses as possible to try to lump things together where appropriate. Everybody has cash, everybody has receivables, everybody has inventory, everybody has property. And the point of merging the balance sheet together is to consolidate in some form. So as opposed to having an individual line item for each acquire and target line item, you do want to think about where to consolidate where appropriate. So what I'm going to take it section by section, and I'm going to look at the acquirer and target's current assets and pull them in. So the acquirer, Office Depot, has 4 current asset line items: cash, receivable, inventory, prepaid expenses. We obviously pull them in: cash, receivable, inventory, prepaid expenses. Where I can pull in acquirer cash, we're doing 2012. Comment on timing. Here in the full scale model in the case, we can be more accurate with timing, right? Remember, we're actually building a 2013 projected analysis as of January 2007, the 27th, 2013, which means for the balance sheet, we need a 2012 balance sheet. So that confuses a lot of people, right? People think, oh, 2012 balance sheet, why have 2012 balance sheet? Why don't we have a 2012 income statement, right? And the balance sheet, when I say 2012 balance sheet, I mean a balance sheet as of the day of January 26, 2012, meaning that the next day, January 27th, is the first day of their projected year. So you always want to merge the balance sheet as of the day before to give us projections for next year. So make sure you know that. So even though we're doing full year projections 2013, you want to merge the prior year's balance sheets. Balance sheet is at a point in time. So cash equivalents, we can just copy down because the line items are one on top of each other. We have cash, receivable, inventory, prepaid expenses for the acquirer. Okay, make sure you have that. Okay. For the target company, let's look at the line items they have. So in the target company, we have cash, receivable, inventory. Same line items, right? No need to make second line items for cash, receivable, and inventory. So I'm going to pull in cash, receivable, inventory. I'm going to pull in cash in from Office Max 2012. Cash, receivable, inventory. They also have the fourth line item. Oops, sorry, they don't. Cash, inventory, receivable. Cash, inventory, receivable. Okay? You guys okay with that? Now they have a line item, deferred taxes and receivables. Now I thought to myself, well, that's weird. They have receivables and then they have deferred taxes and receivables. Why do they have two line items of receivables? So I said I almost thought that because of the word receivables, well then deferred taxes and receivables could be lumped in the consolidated receivables. But then I said no, because they have a separate line item of their own for receivables. So this is maybe a different type of receivables. Or this is maybe just the majority of it is deferred taxes. They didn't explain what the difference was. So to be on the safe side, I separated this as a separate line item.
So that wasn't even available in the Goodwill's call?
It wasn't. And because they separated it on their individual balance sheet, I said maybe it should be separate throughout.
Okay.
That was my thought process. I wouldn't recommend combining it. So the acquirer doesn't have that line item. So here I added an additional line item that would really be held at the target only, but once consolidated, it would be in the consolidated that pulls in from the target company's deferred taxes and receivables. Okay. And then underneath that for Office Max, there's another line item for other current assets. And so now this is also a toss-up. On the acquirer, they have this line item for prepaid expenses and other. So I could pull it in there because it includes other, or I can make another line item for other current assets. So this is where I'm recommending you can start combining items with like terms. They've lumped other current assets into the prepaid expenses. So I would do the same. I would pull in other current assets from the target company into here. So this is where what you're doing is you don't want to change what's on the acquire and target balance sheets, but you may rearrange things so that they line up better for stronger consolidation. Okay, and then we can alt equal sum all this up, right? This is what you should have for acquire and target. Don't stress too much about it because we're going to project it depending on what our base is regardless. Okay, now let's look at the non-current assets. For Office Depot, they got PP&E, Goodwill, other intangibles, deferred taxes, and other assets. Solid, standard major line items, 5 of them. I'm just going to pull them in as they have listed it. So I'm going to pull in PP&E from the acquirer. And I'm going to copy this down, 1, 2, 3, 4, 5. These are the major line items, PP&E, Goodwill, other intangibles. Oops. Sorry. I'll pull down the first 3. PP&E, Goodwill, other intangibles. Pull down the first 3 because the other 2 were created for the target company only. Okay? So, you have a template, so it's a bit easier to see. At the time, before getting to the target company, this is what I had done, right? I just listed the 5 line items that were at the acquirer, right? And I linked them in. And then once I went to the target company and realized, the target company has 2 additional line items, I added those line items later. But, that's in the template, you'll see the format of all those line items already in there. But just the actual procedure when I was creating this, I only pulled in the 5 line items that I had seen from Office Depot. I didn't know ahead to add, to put in titles for 7 line items, just so you know. So I pulled in deferred income taxes, and I pulled in other, right? Okay, so this came from the respective line items in the target balance sheet. Okay. And for the target company, I went ahead and tried to match. So I see that they have PP&E. I see they have intangible assets. They don't have goodwill. So I'm going to pull in target PP&E. I'm going to pull in target PP&E, Office Max. Okay. They didn't have goodwill. So I'll leave it blank. You can put a 0 in there if you want. They did have other intangibles. Other intangibles. Okay. And it was at this point I realized there's 2 line items that the acquired company did not have. Investment in this Boise Cascade Holdings, timber notes receivable. So I added those line items at this juncture. That's when I added those 2 line items with those titles. And said, okay, let me link those in, right? The investment in, that's the way I did it. You could have put those in at the bottom. It doesn't matter the order that you're putting them in. And then I noticed that underneath that, they have deferred income taxes, and they have other non-current assets. So that's the way I'm matching up the line items best I can, right? I guess I could have put investment in timber notes receivable. No, I wouldn't have put them in other. I would have kept it like this. And I'm going to alt equals, adding everything up, including the current assets. And that's what you should have. Make sure you have those numbers. I'm just going to save this. Okay, make sure you can match that. Take a second. Let me know if you have questions, but we're basically just tying in line by line. Okay. Same thing, current liabilities. Current liabilities, let's look at Office Depot for current liabilities. Office Depot only has 2. They oddly lumped a lot together. Accounts payable, accrued expenses, and other. And they have short-term debt. So I pulled that into a line called accounts payable, accrued expenses, and other. Office Depot. Okay. Very simple. The target company wasn't that simple. The target company had 4. Accounts payable, accrued expenses. Okay, so that's obviously goes into the first line. Accounts payable, accrued expenses. Then they had income tax payable, which the acquirer didn't have. Now, income taxes payable, maybe from the acquirer's standpoint, they could have defined income taxes payable in accrued liabilities. I didn't know. So that's where it got a little bit tricky. You don't know what they meant as other accrued liabilities. They could have very well meant income tax payable. That could be another liability. I chose to keep it separate. This is where it can be a little bit of a toss-up. It's so small, though, it doesn't matter so much. On Office Max, you also see other current liabilities. Now, be careful about assuming other current liabilities is other accrued liabilities. Current liabilities could be debts. So you don't want to lump in other current liabilities as accrued liabilities. You want to be careful about that. So I made a separate line item for other current liabilities. Okay. And then we have this current portion of debt, the short-term debt, we'll lump it in as the short-term debt. Up here, we have the short-term debt and current portions. That's what this is here. That's what you should have. Any questions on that? Okay. Now we get to long-term liabilities, where the acquirer has just two: deferred taxes and long-term debt. So I'm going to pull in simply deferred taxes and long-term debt. And for the target company, they got a lot, right? They got long-term debt. They have another type of debt that we determined will be consolidated into the acquirer, this non-recourse debt. Let's pull those in for now. Long-term debt and non-recourse debt. So long-term debt is here in the second row. I'm going to pull this in. Long-term debt. I created a line for non-recourse debt. I started adding lines for things that didn't already exist. Okay. Underneath, they had this compensation and benefit obligations. Acquirer didn't have any indication for what that was, so I pulled that in as compensation and benefits obligations. They also had this deferred gain on sale that the acquirer didn't have. I pulled that in, deferred gain on sale. And a non-controlling interest, and they had this other long-term liabilities. So, this is another toss-up. I was going to put in another line for other long-term liabilities, but I saw at the top deferred income taxes and other long-term liabilities. So I ended up mixing that in since they actually defined it as other long-term liabilities. So I put other long-term liabilities in here. I mean, if you had decided differently, and I don't think it would have made that much of a difference.
For the deferred income taxes and one-time debt, actually it's in the same line item.
No, because these are non-current.
No, I'm talking about the
Up here?
Saying the deferred income taxes and the long-term debt we require.
It's the same as the current liability.
No, these are non-current. These are non-current. These are current.
I think he's saying that the 1871.8 is repeated twice.
Oh, you may have pulled it in two places.
Yeah, page 431.
Oh, yeah, sorry. 126. Thank you. Sorry, that should be 126. There you go. Yes. And then finally, non-controlling interest in joint venture. We can add up the total liabilities. And this is what you should have. Yeah, they're not too far off. Let me know if you have. Yes?
Your long-term debt net of current maturities should be 485.
Oh, I did the same mistake there. Okay, sorry. Okay. All right. Thank you for that. Same idea with equity. Okay, so for equity, what do we have for the acquirer? For the equity, we got common stock, accumulated other comprehensive income, and treasury stock. So common stock, I pulled in those 3 line items, accumulated other comprehensive income, and treasury stock. And for the target, we have preferred stock, common stock, and accumulated comprehensive income. So no treasury stock. So I'm going to pull in first. What I'm going to do is I'm going to pull in the common stock and the accumulated other comprehensive income. They don't have treasury stock, but they have preferred stock. So I put preferred stock for some reason on the bottom this time. It doesn't matter where it goes as long as it's in the right section. Added everything up. And in the balance sheet, I don't think we face this for Walmart, but sometimes you'll see things even outside of the shareholders' equity section. Non-controlling interest is now new rules. It should be in its own section outside of shareholders' equity. Just note that. That was a new rule. Sometimes there was a toss-up. You could have chosen in GAAP whether it should be a liability or whether it should be shareholders' equity. Now it must be in its own section. So sometimes you'll see that. Just do whatever they do in the balance sheet. That's all you got to know as an analyst. Just match what they have. So for Office Max, they had this section outside for redeemable preferred stock and non-controlling interest. And so let's do that. The target company had nothing like that, so we just left that blank. Doesn't matter. And hopefully things will balance. So we'll have total equity. You can have total equity for each. And the sum of the liabilities and equity, if I pulled things in without any mistakes, should balance. So before getting into the actual adjustments to the balance sheet, let's quickly lay out the purchase price allocation. And I have this in this Goodwill and intangible assets box. It actually should be relabeled as purchase price allocation. Where we have those 4 major categories for where your purchase price over book value should go. So now let's first pull in the purchase price. And very important, although it's not significant here, but will be in the LBO, the purchase price that you pull in is the equity value of the purchase price. Right? If your purchase price is based on a multiple of EBITDA and is an enterprise value, and you pull that into your balance sheet will not balance because it already includes net debt. You're effectively double counting net debt. I don't expect you to get that yet, but that's what's happening. You want to take the purchase price and you want the equity value of the purchase price. Right? Purchase price minus net debt. So if you're pulling in the purchase price and you realize, oh, this purchase price is based on an enterprise value, add a row here called net debt and take the purchase price and subtract the net debt. Now, we're going to be in trouble here because when I pull in target book value from the consolidated financials, the target book value, just, even though it doesn't make a difference here, if there was values here, the book value you want to pull is the total shareholders' equity, right? Because the purchase price is representing the price paid for the public shareholders. And preferreds, which is part of here too. Right? Make sure you're capturing the right one. If they had a non-controlling interest investor and you pulled in this number, you'd be wrong because they are not doing a stock swap for that minority or non-controlling interest holder's equity. That's a separate deal, always. They're doing a stock swap on the common stock and the preferreds, which are represented here, preferreds, common stock. Now, we have a problem. We're going to have negative goodwill, so I'm not going to have a great example here. But let's pretend that the target book value for now is $750, so I can explain to you the purchase price allocation items. And we'll revisit this in the LBO. The LBO, they paid a premium. So you subtract to get the purchase price over book value. The model crashed. You'd subtract the 940.6 minus the 750. And we'd want to figure out, okay, how much of that can be allocated to intangible asset amortization? Now, as an analyst at this point, of course, you're never going to know that number. In the book, I have a table that shows the percentage in historical deals that have been allocated to intangible assets based on industry. You can use that as a guide. As a standard, we conservatively use 20 or 25%. I forgot what we used in the book, but the point is, as an analyst, as long as you're putting these things in place so that when it comes down to the end of the deal, you can easily drop in the adjustments, right? At some point, you'll just be hard coding in what the allocation to new intangible assets are. If 25% we're assuming is a conservative approach to figure out how much of that purchase price over book is relatable to intangible assets, then we will take 190.6 times 25%, and we'll amortize that over 15 years. 15 years is standard amortization. So I'll take that 47.6 divided by 15. And as an aside, we hadn't done this yet, we can go ahead and pull that amortization in to the income statement and the cash flow statement. 40, divided by 15. Okay. So that's the amortization. That let's just do that now. Let's pull that in to the income statement. If you notice, we left this line out for amortization of the identifiable intangible assets. We can pull that in from the assumptions. Copy to the right. Just make sure I can take the highlights out because let me anchor this so that when I copy it to the right, it will properly flow. Okay, make sure it's calculating through. And you want to make sure that it's also linking through into the cash flow statement, which it is. So we can link that in. And here are the other adjustments. So I want to demonstrate this in the balance sheet adjustments. I'm going to highlight this yellow because when we pull in the actual book value, it's going to be negative and this is all going to zero out. But just to illustrate this, let's assume that appraisers come in and said, all right, well, of the purchase price of, let's say, about $100 million, I think your assets, the target assets, are understated by $100 million. So I want to step up the assets by $100 million. Okay. Now let's say because of that, because you have $100 million more in assets, what impact would that have on deferred taxes?
When you're going through doing new depreciation statement, you accelerate your depreciation, you'll have an increase in deferred tax liability.
Yep, and how would you calculate that?
By actually,
Yeah, how would you do it?
the depreciation schedule, you'll have your PP&E.
Okay, but what's the quick math for it? You know the formula, right? Accelerated depreciation minus straight line times tax, right?
Yeah.
So let's say we're doing Maker's schedule. Let's say the straight line is 10 years. How would I figure out quickly with this, how the step up of PP&E would interpret into a deferred tax liability?
The Maker's first year is 25%, right?
Let's assume that.
So it'll be 25%, so 25 minus 10, 15 times the tax rate.
Yeah.
And that will be your adjustment for that first year.
So we can quickly do equals, let's just say 100 times 0.25 minus order of operations, that'll work, right? 100 divided by, what do we say, 10? Let's say 10 times 35%, whatever. I mean, just as a quick example. So there's an additional intangible, you don't have to do this, but additional intangible asset, there's an additional deferred tax asset created of 5.3. My point is, Goodwill is the remainder. Goodwill is the purchase price minus the book value, and everything. So that 190, we want to try to allocate to as many places as possible. So we've allocated a portion to intangible assets, minus the step up of PP&E, minus deferred tax assets. This is everything that's left over. This is everything that we've not been able to allocate. So the benefit is, instead of just throwing everything up at 190.6 at book value that you can't amortize, you can't really get much tax benefits for, we were able to allocate a bunch to PP&E that we can now amortize over time. That gave us a deferred tax asset, we're able to allocate some to intangible assets that we can. So we're finding places to put this that can give us more tax deductions. Okay, are you getting comfortable with how that's working? So for this case, though, let's make the target book value, let's link the target book value as it should be. Let's link the target book value into Office Max, into the consolidated financials, which was the 10344. And the problem what that does is that gives us a negative purchase price over book, actually negative goodwill. So for that purpose, we can't have negative intangibles. So this percent book tangible to amortization, let's hard code at 0. Okay. And this step up of PP&E, let's put back to 0. So the reason why I want to give you a different example is when you have negative goodwill, there's not much to talk about here, but I wanted to show you what it would do. And in the Heinz LBO example, we'll have a lot of purchase price over book value to play with. So if we make this 0, make all this 0, really what you have is they're paying a discount, and that lump of the discount just goes to a negative goodwill balance. That's all you want to know here. But I didn't want to have a conversation on this, so that's why. Yes, Sammy.
What is it with the purchase price is less than the book value? Because I mean, typically the shareholders of the target company would just say, no.
They paid a 9.8% discount. I mean, we discussed this on, was it Monday or the other day? They paid a discount. I don't think you were here. Yeah,
wouldn't it be easier for them to just liquidate the business and they end up with money?
we did that analysis. They ended up, what was it, over 100, and they were receiving over 100% return so far? Right? What did we calculate? 100? Yeah, 103% return. Yeah, they got a benefit. They ended up getting a benefit by the nature of the stock swap. Yeah. Okay. Let's take a break here because I want to go back to the board and then talk about making the actual adjustments. Before we apply those adjustments, we need to set up our total column so that it handles acquirer plus target plus additions minus subtractions. Right? So the total column must be acquire plus target plus additions minus subtractions. Right? All the way down. So we'll take that, we'll copy it all the way down. Addition, acquire plus target plus additions minus subtractions. No.
We're not breaking up into debits and credits. We'll just have additions and subtractions.
Right. That's right. I didn't make that clarification. Yes. In this model, and this is the way I like to do it, I showed you the debits and credits because a lot of the banks do it that way. But to me, it's just easier to have an additions column and a subtractions column. And in that case, you don't have to flip it for liabilities and for equity. It's just if you're going to add it, put it in the additions column. If you're going to subtract it, to me, it just makes a lot more sense. So I have one column for any addition, one column for any subtraction, regardless of whether it's a credit or debit in terms of T accounting. I just think it's simpler that way. But I want to show you both ways. You can choose whatever way is right for you. Right. The biggest difference is if you're doing the T accounting method of debits and credits, you got to flip the signs when you go to liabilities and shareholders' equity. So sorry, good clarification. What you do have to do though is redo your totals in each section so that they total top down, not left right. Otherwise, the totals won't capture the adjustments that you're making in the individual line items. Right. So you want to go down and make sure that you are adding the totals top down, cleaning it up a little bit. Right, make sure you're getting all the totals. I guess you can also just copy the totals from the left. That's another quick way to do it. And you just want to make sure it balances, right? The sum of the individual balancing balance sheets should definitely balance. Make sure that you have that. You guys have that? Okay. So what's the first adjustment we can make? Okay, what about cash? Acquire or target? No.
Requires cash.
Target cash, we're not paying down, right? No target cash, right?
No target cash? Meaning we don't do anything with target cash? Or
Right.
we move the target cash?
You do not do anything with target cash.
Due to the acquirers.
Acquire cash, right?
Why is that?
It's the acquirers and who's paying.
Yeah.
So our cash is no longer on the balance sheet, it's now with the shareholders in the funds.
The target cash
Basically, that buffer part,
stays on the,
bank accounts.
there you go. So the target cash is staying because it's not, it would be part of net debt if it was anything. The acquirer's cash from the sources, the acquirer is paying. Well, let's start with, what are we eliminating? Let's start in order. What are we eliminating aside from the cash? In terms of, let's start from top down. Purchase price. What does the purchase price represent? Let's organize this. Okay, so what about the book value?
So we need to eliminate the targets Goodwill.
Let's eliminate the targets, not Goodwill.
Sorry, book value.
The shareholders' equity. Yeah. Target shareholders' equity. So the whole target shareholders' equity section will go, right? This whole section here. So we're going to have a subtraction where we're eliminating out the target shareholders' equity. Right, so effectively you're left with the acquirers.
So had we had in the target section, those two lines underneath total shareholders equity, would we subtract those out as well? So the redeemable preferred stock and non-controlling.
These?
Yeah.
No. That's what I'm saying. You're representing this.
Okay.
This stays.
Okay.
Yeah, the shareholders' equity is just up to here. Yep, absolutely. Right? Because the purchase price represents just the public shareholders' equity. Good point. Okay. What else does the purchase price represent? Goodwill. So we'll pull in the goodwill from the bottom, right? As an addition, we are adding in the goodwill, which is ultimately a negative, right?
Have you amortized negative goodwill, or how do we deal with that moving on?
It just sits on your balance sheet as negative.
Yeah.
But you amortize? No, you don't amortize it.
You never touch goodwill, right?
Huh?
You never amortize.
You never amortize goodwill,
You
yeah.
write it down.
Yeah, you can ultimately write it off at some point.
But if you were to write, if you were to write this off, it actually have
It's
a
a benefit.
positive
Yeah.
impact. So I'll ask you offline, but that just sounds kind of fun, right? It's yeah. Because I understand you have 100 million and it's worthless, so you make it 0 and you take a non-cash hit. If you go from -93 to -193,
Or you go up to 0.
You go up to 0, so your equity would go up.
Yeah, your equity would go up, and we would go into your.
I gotta look into the rules behind that. How you write down negative goodwill, if you can. Yeah, I understand. I get you. It's a little weird.
Does it always say negative because you can't write it up?
Well, that's what we're talking about.
It's just on your books forever until you make another acquisition.
To make another acquisition and wipe it down.
Yeah. I don't have this negative number on my balance sheet.
But you can write off. No, but you write off contrary accounts a lot, right? Bad debts, things like that. There's ways to eliminate them from your balance sheet if you really care to not have them on there. So I'm not saying that you can't. I just, in terms of technically how you do it, we're kind of getting into Ernst & Young territory.
Wouldn't that be different from contract accounts because contract accounts are linked directly to another actual asset account?
Well, this is linked to your assets somehow. Your assets, your intangible assets. So we're getting deep into the accounting, Ernst & Young stuff. Okay. If we had intangible assets, we can just link it in if you want. Well, let's do that so we can run some scenarios around this. The intangible assets, I just put in other intangibles. So that would be an addition to other intangibles. That would come in here. If you had a write up to PP&E, that would come in here. So we can show some examples. So if we were to write up PP&E, we have this step up right down to PP&E, that would link into here. And same with an addition to deferred taxes. Right, if we had a write down of deferred taxes, we would do it differently. I'll show you when this is done how to do that. But my point is, it's important to capture all the components of your purchase price allocation. Right, so your purchase price should be a sum of the target shareholders' equity and all of your purchase price adjustments. Right, so if you take these are all the balance sheet line items. Sorry, shareholders' equity line items plus 1, 2, the sum of everything. Oops. That should be your purchase price, 540.59, right? You agree with that? Does that make sense, Daniel? Yes? Go ahead.
Wouldn't the deferred taxes be a liability?
Oh, I mentioned that. Yeah, we'll talk about that. Yeah, if it's an asset based on what we did on the board, that's how you do it. But does this make sense? Yeah. Yes.
You know how we were talking about before the property plant and equipment, you can do a write-up if it was appraised and it said that this is worth more than what it says on the books?
Yeah.
What if it was worth less? Would you bother to do that in this scenario?
Yeah. You basically have like what you have in Goodwill. You just have a negative there.
Okay. But would you have to do it in the merger model, or is that something that the company can then later deal with later down the line and just do a write-down years in the future?
You would do it as soon as you get it. So if you know it's going to be written down here, you would do it here. Yeah. And it would just be negative here. So this link still works for a write-down. What else? Any other questions on this? I know it's kind of weird. You guys got this so far? Kinda. We'll do it again with the LBO, and we'll run some examples on it. Okay, what else? Say again? Nope, debts are staying. All the debts are staying. That would be the natural next step, is to look to the debts. But the debts, if you look at the sources and uses, the uses debts are 0. So if we had them, yeah. Then it's the fees. So how do we adjust for the fees? Yeah. So we will eliminate them from our retained earnings. Where are they? Basically the accumulated deficits. We've already had something in here to eliminate the target equity. We're going to also add to this another elimination. So in that cell we have equals E142. I want to add another elimination to wipe out the transaction fees. So it's down by a further 7.4. You're adding the minus, basically. Yeah. Okay. Now, what about the sources, which Sammy was saying in the beginning? What adjustments do we make there? Equity? Equity's coming in. Let's assume it comes in as common stock. This is the only equity line we have. So we'll pull this in, the assumptions, as equity, line 40.6. Equity comes in. What else? What else happens?
So we don't actually have to make an adjustment for the target's cash because it's already added in.
Yeah, we usually, if there is an adjustment for target's cash, we're assuming that the target's cash is going to pay down the net debt. If we have 0 for net debt, we didn't do anything with target's cash, so we're assuming that that's just going to be added in. Yep. Good clarification. What else? What's not sitting well with you, Daniel? You okay? Okay. You had an expression like you had a question. Yes, Tosin. Oh, sorry. Yeah, that's the E142, wipe down of target equity plus the fees. So H8 are the fees. Sammy?
The acquirer's cash needs to be offset.
Yes. So the acquirer's cash, so we have, this is the equity being raised. The cash that they're going to use to pay for the business would be an elimination. So they're going to wipe out the cash. So it'll be a subtraction from the assumptions, 4.7. And even though we don't have debt, let's just say if we were to raise debt, let's assume it's long-term debt. So I'm going to link in from F133, the assumption of debt. It should balance. Yes, good. So it balances when we've properly captured all the sources and all the uses. If you've missed something, right, it'll be out of balance, of course. So make sure.
Didn't we say at the beginning we were wiping out the acquirer's cash?
No. We're using the acquirer's cash to pay for the fees.
Yeah.
But they don't. Yeah, but they only have 4.7 in fees. That's all they got. So they're not wiping out all that stuff. They're keeping that cash. So they ended up with 1.616 billion in cash. So, if they were to pay down debt, how would this change, to your point? Let's say that they decide to say, no, we're going to pay down our debt.
That's how they pay down.
cash.
Let's say they use debt to pay down debt. They're going to refinance.
And technically, we might have to do it. Because if they're raising debt to pay down the old debt, then those, you add in the new debt.
Yeah, I guess it would kind of wash. No, but let's say we're reconsolidating everything as long-term debt. Just for the mechanics. You never know. Interest rates might be different. You might be, but you're right. It could maybe effectively wash in some way. I want to know the mechanics.
Then take out targets, short-term, long-term, and capital leases, let's say.
You would take it out.
And then
What else would change, like higher level? What would change in the assumptions? Let's start there, because assumptions will drive the balance sheet adjustments.
part of our assumption.
Yeah.
On the sources, you actually have debt,
In the sources you have debt, how much debt?
whatever the amount is, short-term and long-term.
Okay. So what else would change? The uses. Right? So let's see. Let's do it, right? If we said, let's decide to pay down the target's net debt, we would first figure out how much debt we would need to raise. So we would pull in the target company's net debt. And so let's do that. So let's say in H7, we'd link this in from, let's say the target financials are here, right? So I'll pull in the target, short-term debt plus long-term debt plus non-recourse debt minus cash, minus target cash. Got that? And it's short-term, long-term, non-recourse.
You subtract out the cash as well.
Minus cash. Yeah. Which gave us $476,100.
Now, the balance sheet along the balances because we raised new debt, but we haven't accounted for paying down the old debt. So we need to subtract out all the others' old debt.
Yeah, so we're saying we're paying down 476.1, refinancing with 476.1, right? So the debt sources match that, and then we need to make sure, now notice, we're not going to balance anymore, right? So we need to demonstrate paying down the target short-term debt by eliminating it off the target short-term balance sheet. Because right now, it's still consolidating, right? It's showing 174 plus 10 equals 184. So we've got to eliminate the 10.4.2, right? We've got to eliminate the long-term debt of the target, the non-recourse debt of the target, and the cash of the target, right? If we eliminate the cash of the target, so we already have 4.7, I'm going to add to that, eliminating the cash, then we should balance again, right? So I put this back in. You don't have to do that. I'm going to undo this. So we had to make sure we demonstrated in the sources and uses that we were to pay down that debt. And then we need to eliminate those debt line items from the balance sheet. And also, it was already done because we linked it, but also we want to show that we're raising that debt as a source. So F133 equals that source, which we've done. I'm going to undo this to put this back to the 0 scenario because that's really what's going on. Does anyone else have any other questions on this? Okay. We'll do this again with the LBOs, with the Heinz case. It's going to be more meaningful when we actually have Goodwill. Oh, one more thing. If we were to write up assets, this is important because we're going to talk about depreciation now. If we were to write up assets, step up right down to PP&E. Let's say we said, okay, well, your assets are worth $1 million more, or is it $1 billion? Step up, put the step up of $1 billion. Okay. Now, this makes our goodwill more negative though, because we don't have anything to. Usually, if our goodwill was positive, this would dip into the positive. We don't have anything positive. But so what happens is this step up still balances. Will flow into our PP&E. PP&E goes up. The property goes up. And this is why we need to drive depreciation from this consolidated PP&E. This already captures our step up and step downs of PP&E. Right? And notice how so how did we back into the purchase price? How did we match this to the purchase price? It's a way to match these adjustments. It's a tricky way of thinking about it, but it's important to know. How do we test this? Purchase price is what?
So we'll take the goodwill.
Yep.
And the book value.
Yep.
And that right up and adjust it.
All the adjustments. Even, why are they deferred? Oh yeah, there's deferred taxes because my formula is still in there. All that stuff. Right? My point is 945.3, right? Is that right? Yeah, but that because yeah, includes fees. Close enough. My point is, I'm just back solving into this. I'm saying the book value plus this plus this plus this plus this plus this equals purchase price. I'm just back solving into that. Just a sanity check. Okay. I'm going to make the write it down 0. And now that we have the balance sheet, really everything else, there's going to be some exception we'll talk about in terms of process, is like a standard model. This is the last complex thing in a full-scale merger model. This is arguably what confuses people the most, so don't worry about it if you're too. Once we have the balance sheet, then we use the balance sheet to drive the depreciation schedule, the working capital schedule, link those changes into the cash flow statement. Cash flow times the balance sheet. We do the debt schedule. We have our model. This is the biggest piece here. So what I next want to do is just make sure that we're linking this balance sheet into our actual balance sheet below. So if you didn't have a template, what you have to do now is you'd have to create your own balance sheet from scratch using the line items that you've identified based on merging and adjusting things in the consolidated financial statement. And we'd pull in row by row the starting, I call it, we call this pro forma after the transaction, the starting balance sheet that will be used to drive all our supplemental schedules. So I'm going to pull cash in from what we've just created here. And if you've lined up the line items appropriately, this should all match. I'm just going to copy everything down. I don't care about the totals here. I'm going to redo the totals later. Maybe I'll clean this up a little bit. Let's make sure this matches. I want to make sure the line items match up. And this is what I'm going to use to drive all my supplemental schedules.